Welcome to the Deep Dive. We're your shortcut to staying informed without getting overwhelmed. Today, we're taking a close look at a really vital document for understanding one of the world's, most dynamic economies, India. We're unpacking the Reserve Bank of India's Financial Stability Report, the FSR, from June 2025. Now, if you're new to this, the FSR is basically the RBI's big biannual health check for India's entire financial system. Its job is to spot potential risks and see how resilient things are. It covers, everything. The big economic picture, banks, markets, new rules, the whole nine yards. It pulls info from all the different regulators, so it's really comprehensive. Our mission today, to break this down for you, especially if you're maybe looking at India as an investor, we want to pull out the key insights so you walk away feeling genuinely clued in.
Okay.
Let's unpack this report.
Yeah, and what's fascinating here is how timely this report really is. With all the uncertainty globally, it gives you this indispensable snapshot. It's kind of a shortcut to understanding India's financial landscape, especially from an investor's point of view. It really highlights both the big strengths and those areas you need to watch closely.
Exactly. We want to give you the facts, the insights you actually need, not just to be informed, but maybe to make smarter choices down the line. We'll try to balance the big trends with some of those specific details that hopefully stick with you. So to really get a grip on India's position, we need to start with the bigger picture, right? The global scene it's operating in. What's a global backdrop this FSR paints for us?
Well, the report definitely paints a, let's say, challenging global environment. You've got these persistent geopolitical tensions, obviously, and quite a bit of trade policy uncertainty. It specifically flags those large tariffs the U.S. announced back in April 2025. I mean, this pushed the effective tariff rate on U.S. imports way up from about 2% in 2024 to over 15% in 2025. That's a huge jump.
15%, wow.
Yeah. And the consequence, potentially, is global trade growth slowing right down to maybe 1.8% this year. That's nearly half the previous forecast. So, yeah, global GDP growth, inflation dynamics, they're all feeling the pressure. We're seeing deceleration in both advanced economies and emerging markets.
Okay, so quite a few headwinds out there. Sounds like choppy waters globally. But then the report makes this point about Indian resilience. How is India managing to, stand out against that backdrop?
Right. Despite all that global turbulence, India's economy is holding up remarkably well. The report puts this down to strong macroeconomic fundamentals. Growth in 2024 was pretty much on target, and actually key indicators like foreign exchange reserves and the debt-to-GDP ratio, they've actually improved.
Interesting. So improving even with the global slowdown.
Exactly. And the report explicitly says this resilience makes Indian markets a relatively safe investment destination.
So if I'm an investor looking at India, what's the big takeaway from this global versus domestic picture?
It means basically that while the world is definitely volatile, India is showing itself to be a more stable anchor. That underlying economic strength provides a sort of buffer. It suggests that even if global markets get rough, India might offer, a relative advantage for investors who are selective in thinking long term.
That really sets the stage. Okay, let's drill down then. What's the FSR telling us about India's own markets? Equities, bonds, the currency, what's happening there?
Okay, so starting with equities, Indian valuations are, high. The Nifty 50's forward PE ratio, that's basically what investors expect to pay for future earnings, was pretty elevated as of early June 2025. It kind of implies a lot of future growth is already baked into current prices.
Right. Optimism is high?
Very high. But overall market volatility has been fairly contained, and India's weight in the MSCI Emerging Markets Index is holding steady around 18.5%. But here's a crucial note of caution from the report, especially for investors. Be wary of overvaluation risks, particularly in microcap stocks.
So really small companies.
It's exactly. Often less liquid. And the report notes domestic institutions own a significant chunk here. It maybe hints at some pockets of, let's say, excessive enthusiasm. Now, moving to bonds. We're seeing increased liquidity, which is good, but also more volatility. You can see this in wider bid-ask, spreads the gap between buying and selling prices, and bigger daily swings in yields.
Okay, so more movement there.
Yeah. Corporate bond issuance and trading activity are strong, which suggests opportunities in fixed income. But for investors, it definitely means you need to be more aware of interest rate sensitivity. Active management is probably key.
And the rupee, the exchange rate.
The USD-INR rate has been quite stable, actually. But the report does warn that, big global currency shifts or geopolitical events could definitely stir things up. So if you have foreign currency exposure, thinking about hedging strategies might be pretty prudent.
That makes sense. Okay, clear picture on the markets. But this brings up a really important question for any investor. What about the underlying health? How are Indian companies doing? And what about households? Are they strong?
Yeah, this is where it gets really interesting, actually. There's a bit of a split picture. On the corporate side, things look pretty resilient. Companies have kept solid operating profit margins, even though sales growth has cooled off a bit. That's quite impressive.
Okay.
Their debt service ratios are stable. They've got good cash buffers. It basically implies low default risk, especially for the higher quality corporate bonds. So a strong story there.
So far, so good on the corporate front.
But when you shift focus to households, it's a bit more nuanced. Household borrowing has grown significantly, particularly unsecured retail loans, things like personal loans, credit cards. Per capita debt is rising. And here's the crucial point the report flags. Asset quality in these unsecured loans is showing elevated slippages, especially for private banks.
Slippages, meaning loans starting to go bad.
Exactly. It's an early warning sign.
Yeah.
Loans moving from performing towards non-performing. This definitely signals caution for investors looking at, say, consumer finance, NBFCs, or banks heavily into that unsecured retail space.
Right. That's a really important contrast. Strong companies, but maybe some pressure building on the household side, specifically with those unsecured loans. This naturally leads us to the institutions at the center of it, all the banks and the NBFCs. How are they holding up? What's the verdict on these pillars of the system?
Well, the banking sector, specifically the scheduled commercial banks, or SCBs, looks incredibly robust right now. Their capital adequacy ratios, the CRAR, are actually at a record high. And get this, gross non-performing assets, GNPAs, are down to 2.3% as of March 2025. That's a multi-decadal low. Net APAs are even lower, just 0.5%.
Wow, that is low.
It really is. It shows very strong asset quality,
Yeah.
likely reflecting all the cleanup efforts over the past few years. Now, overall SEB credit growth did slow a bit in 2024-25, but personal loans and loans to small and medium enterprises, MSMEs, they remain strong. But again, we have to echo that warning about the higher slippages and unsecured retail loans, particularly for private banks. It's a specific area to watch.
Okay, so strong overall, but that one pocket needs attention. What about stress tests? Can they handle shocks?
The stress tests are quite reassuring, actually. The macro stress tests suggest banks could weather even pretty adverse economic scenarios, with their capital ratios staying well above the minimum requirements. And the liquidity tests also confirm they're generally well-positioned to handle unexpected cash outflows.
Good to know. And the non-banking financial companies, the NBFCs?
NBFCs are generally seen as healthy, too. Strong capital buffers, decent interest margins, low impairment levels overall. However, their slippage ratios are trending upwards. And the report does point out some outlier NBFCs showing maybe faster credit growth and higher write-offs. So not all are the same.
Right. Need to be selective there, too.
Definitely. And on their funding, bank lending to NBFCs actually dipped slightly, but banks are still their main source of funds. So if you're investing in NBFC bonds or stocks, the report suggests monitoring their liquidity risk, as it notes some potential cash flow mismatches down the line for certain entities.
Got it. Any quick word on others, like cooperative banks?
Yeah, quickly. Urban cooperative banks, UCBs, show improvement in credit profiles and asset quality, which is good. But stress tests do show they could be vulnerable under severe shocks. On the other hand, mutual funds and clearing corporations look resilient in stress scenarios, which adds to overall market stability.
And how connected is everything? If one bank gets into trouble.
The system is highly interconnected, especially the interbank market where banks lend to each other. But the good news is the assessment suggests contagion risk. The risk of trouble spreading from one hypothetical bank failure seems limited, unless it's amplified by a really severe macroeconomic shock. So there seem to be some fire breaks built in.
Okay, so it sounds like a strong core financial system overall, very solid fundamentals, but with specific areas like unsecured lending and maybe certain NBFCs that investors really need to keep an eye on. But what's underpinning all this? Beyond just the numbers, what are the regulators actually doing to keep the system stable and transparent?
That's a really crucial piece of the puzzle, isn't it? Regulation is like the hidden architecture. Globally, regulators are wrestling with things like trade tensions, cyber threats, climate risks. The Financial Stability Board, for example, is working on frameworks for climate vulnerabilities. Domestically, India's regulators seem very proactive, very adaptive. We're seeing real action.
Like what, specifically?
Well, things that directly help protect everyday investors. SEBI, the markets regulator, has standardized how mutual funds disclose risks, making it clearer. They've also put safeguards around algorithmic trading by retail investors. That's important for market integrity.
Okay, protecting the small guy.
Exactly. Then you have moves strengthening the system's backbone. The RBI revised rules for those urban cooperative banks and set guidelines for electronic trading platforms. The pension regulator, PFRDA, got the Unified Pension Scheme under NPS up and running, which is boosting pension fund growth. The Insolvency and Bankruptcy Board, IBBI, has tweaked processes to make resolving insolvencies smoother, even helping with voluntary liquidations. And IFSCA, overseeing the International Financial Services Center, touted up reporting for fund managers there, improving oversight.
Seems like a lot of tightening and transparency efforts.
Yeah, and it's worth noting, while complaints about loans and credit cards were high in 2024-25, there's also this platform, Smart ODR, which is apparently getting much better at resolving disputes efficiently. That helps build trust.
So looking at all these regulatory moves, standardizing disclosure, improving oversight, smoother resolution, what's the big takeaway for investors listening to us?
The main takeaway is that these steps significantly boost transparency and improve risk management across the board. This ultimately creates a, well, safer and more predictable environment for investing. So if you're in mutual funds, pension funds, or looking at IFSC entities, you benefit from clearer information and stronger oversight. Now, the flip side, maybe, is that compliance isn't free. These rules might add costs, especially for smaller players, but that's often the trade-off for greater overall stability.
Makes sense. Stability comes with some costs. Okay, so we've looked at the data, the institutions, the regulations, but what about the feeling? What are the experts themselves perceiving? The FSR includes that systemic risk survey from May 2025. What did that tell us about risk perception and confidence levels?
The systemic risk survey. Yeah, that provides a really interesting window into a collective mood, if you like. The major risks people identified, mostly global. Trade disruptions, geopolitical conflicts, cybersecurity threats, those were top of mind. Domestically, concerns like a potential growth slowdown or rising U.S. Treasury yields were also mentioned.
So the usual global worries are definitely there.
They are. But here's what's really striking. The contrast in confidence. While two-thirds, 66% of respondents, said their confidence in global financial stability had worsened, over 90% expressed stable or even higher confidence in India's financial system.
90%, that's huge.
It's a massive vote of confidence domestically, especially when you set it against that gloomy global outlook they also see.
And what did they expect for the banks specifically?
They expected a slight uptick in bad loans, specifically because of that unsecured lending we talked about, reinforcing the FSR's data. But on the positive side, they anticipated better credit demand ahead, driven by things like stronger rural demand and generally better business sentiment.
So that survey really paints this picture of India as maybe an island of relative confidence in a worried world, a blend of caution on global stuff, but real conviction domestically.
That's a good way to put it, a blend of caution and conviction.
Okay, let's bring this all home then. Based on everything we've unpacked from the FSR in this deep dive, what are the concrete, actionable investment implications for our listeners? The real so what?
Absolutely. Let's try and distill it down. For equities, the opportunity seems to be in large cap and mid cap stocks. Think sectors like banking, infrastructure, consumer goods areas buoyed by India's overall resilience. The risk, as we flagged, is those high valuations, especially in microcaps, and potential volatility from global trade issues. So it really calls for being selective and making sure you're diversified.
Right. Selectivity is key. Fixed income.
Fixed income. Corporate bonds and government securities still look like they offer stable returns. You've got strong corporate balance sheets behind them, and bond market turnover is improving. But the risk is that rising volatility and sensitivity to interest rates. So you really need to think about managing duration actively, how sensitive your bonds are to rate changes.
Okay. And banks and NBFCs?
Banks with those strong capital buffers and low bad loans, they look like the safer bets. Pretty robust. Stable NBFCs with varied funding sources could be attractive for growth, perhaps. The clear risk, though, is being overexposed to those private banks or NBFCs with a lot of unsecured retail loans, given those elevated slippages. Due diligence is crucial there.
Makes sense. What about funds?
Pension and mutual funds. The growth in NPS and overall fund assets under management provides good long-term options, and they benefit from those regulatory safeguards we discussed. Key thing for investors here is just monitoring liquidity risks, especially in some mutual fund categories, and making sure your choices align with your own risk appetite.
And finally, managing overall risk.
Yeah, hedging. The report implicitly supports considering currency and interest rate hedges. They can be really useful tools to cushion against shocks from global currency swings or potential rate hikes down the road.
This is really helpful. It feels like a comprehensive roadmap for navigating the Indian market, directly based on the RBI's own deep analysis. So, if we were to summarize our deep dive today, the RBI's June 2025 Financial Stability Report really underscores India's financial system as, well, a beacon of stability in what's clearly a pretty volatile global environment.
Indeed. And if you connect it to the bigger picture, it's all about making informed choices in a really complex world, isn't it? The strengths are definitely there: solid banking fundamentals, healthy corporates, proactive regulators. But investors absolutely need to stay watchful about those high equity valuations, the rise in household debt, particularly unsecured, and those ongoing global uncertainties, especially trade. It's like a system built on solid ground, but you still need to navigate carefully.
So, here's a final thought for you, our listener, to mull over. Considering India's remarkable stability, alongside those specific risks the FSR highlights, how might this influence the way you think about diversifying your own global portfolio? Not just in terms of where you put your money, but maybe also in understanding where future economic strength and genuine resilience might lie.
Yeah, it really just reinforces how valuable it is to stay informed, doesn't it? To look beyond just the headlines, dig into the data, and really understand the unique stories shaping different economies in this very dynamic landscape we're in.
Well said. Thank you for joining us on this deep dive into India's financial stability. We hope it's been insightful. We encourage you to keep exploring, keep learning, and we'll be here next time to help unpack it all.